Hi folks, hope you all are doing well. I'm Karan Bandal from Econosite, your weekly economic wrap from India and around the world. So let's get started with the banking sector. US banks and their collective balance sheet. With the collapse of some of the mid-sized banks in the United States recently, there is a lot of focus on the banking sector here. Let's look at this sector from a macro perspective. As of the beginning of 2023, there are over 4,000 FDIC insured banks in the US. FDIC insurance is substantial and insures deposit accounts up to $250,000. US banks have over $20 trillion in liabilities and over $22 trillion in assets. Now, from a banking perspective, the loans that banks issue are their assets, since these loans generate profits and cash flows for the banks. This used to confuse me a little bit. And banks' liabilities are the deposits from depositors, since banks have to pay depositors interest and the whole deposit back if they ask for it. This is the money that they owe to us or depositors. Let's zoom into the asset side. Loans and leases are the primary income generating assets for the banks, making up 53% of the total assets held by US banks. Of this, real estate loans make up the majority at 45%. Two areas of concern here. First, with remote work taking hold in the last 3 years, office space occupancy rates have plummeted. In response to this shift, companies may scale down their leased office spaces, impacting the profitability or even viability in some cases of these properties. Will this then affect cash flows coming from these properties to the banks? Second, consumer loans. Credit card loans are nearing $1 trillion mark, and other consumer loans that include car loans are approaching a $900 billion mark. A recession or a slowdown that is expected will weaken the consumer, impacting this asset class for the banks as well. Treasury and agency securities are probably the safest assets for the banks at about $4.1 trillion, since these are debt instruments issued by the US government. Moving on to liability side, other deposits make up the majority here at around $15.3 trillion. These are small deposits that customers like you and me entrust to these institutions. In addition to that, there are $1.85 trillion of large time deposits. Again, liability of a bank is anything that the bank owes to its customers. As of Q4 2022, US banks had a net interest margin of 3.37%, meaning they paid on average 1.17% interest on the deposits and borrowings, while through the loans they issued, earned an average interest of 4.54%. Moving on to India-US connection, India Inc.'s US investments. Indian companies have been investing in the US quite heavily now, especially since 2020. The firms have invested more than $40 billion in the US so far. This has created employment for 425,000 people in the United States, a sharp jump from 125,000 jobs number seen 3 years back. Notably, up to 50% of Indian investments were focused on the US's pharmaceutical and information technology sectors. Naturally, we saw Indian business giants such as Tata Consultancy Services, Infosys, etc. substantially expanding their US operations in recent years. Companies have spent close to $185 million in corporate social responsibility and nearly $1 billion towards research and development. In terms of geography, Texas has been the hotbed for Indian investments, with $9.8 billion invested in Texas alone, creating 20,000 plus jobs there. Just 5 states in the United States are attracting almost 60% of the Indian investments, and most of these Indian firms have plans to expand further and invest more, hiring more employees over the next 5 years. Finally, India and the US dollar. India's foreign exchange or FOREX reserves are sitting at a comfortable level currently at $588.8 billion. They recovered sharply from a low of about $524 billion seen in October of last year. At the time, rupee had hit a record low against the US dollar, but since then, the RBI or Reserve Bank of India has been rebuilding the reserves, taking advantage of the rupee's recovery. Here is how RBI manages the dollar-rupee exchange rate. RBI attempts to maintain the Indian rupee's value against the US dollar in a stable range. Currently, $1 is valued at between 81 and 83 Indian rupees. When the dollar rises sharply against the Indian rupee, clearly there is more demand for the US dollar and buyers are willing to pay a higher price for the dollar. RBI responds to this situation by selling some of the dollars from its reserves, which increases the supply of the dollar in the market and thus arrests the rise of the dollar. This dynamic plays out in reverse when the dollar falls against the Indian rupee. RBI basically manages the supply-demand curve as the bank attempts to maintain the rupee range-bound. RBI bought more than $8 billion in the spot market in November and December of 2022. Reserves are now equivalent to 10.4 months of import cover. On the policy front, US Fed is expected to pause its rate hike cycle, softening the dollar's outlook, meaning there will be less pressure on the Indian rupee and RBI may be able to add to its reserves kitty, or at the very least won't have to draw down the reserves in order to maintain the rupee's value against the US dollar. In summary, US banking sector is going through some turbulence right now as a result of a sharp rate hike cycle by the US Fed in the last year. The overall balance sheet of US banks does not look alarming, but there are certainly some glaring concerns. Indian investments in the United States have picked up pace since 2020 and Texas has been the primary beneficiary. And India's foreign exchange reserves position is quite comfortable. Another economic indicator signaling optimism about India's economy. I hope you found this week's wrap interesting. I'll speak with you again next week. Until then, take care.